Welcome everyone to Tax Power Hour, Small Business and Self-Employed Tax Tips and Tricks. Today is March 1st, 2017, and this is the March webinar. This is a monthly webinar that we do the first Wednesday of every month. Today's episode is taxation across multiple entities. So proprietorships, corporations, S&C corporations, partnerships, and then lastly, LLCs. We're going to clarify what are LLCs and how do they play a role into all this. Okay? All right, today's content. We're going to spend about 5 minutes on the introduction talking about the Tax Power Hour and other recommended events and things that we're doing, that I'm doing, and stuff that the guest speaker is doing as well outside of this webinar. We're briefly going to talk about business deductions just to kind of set the pace about what's the whole why we incorporate from a business tax perspective. We'll talk about sole proprietorship and we'll compare it to a corporation just because those two are the perfect spectrums that are in both poles on both sides of the equation here. Then we're going to talk about the pass-through entities, which are partnerships and S corporations. Then we get into LLCs, and we'll do a full comparison of all of them. Then we'll discuss a couple of non-tax consequences and then other recommended events. Anyway, what is Tax Power Hour? We are a small business and self-employed tax tips and tricks community. We have monthly webinars, which some of you are attending live and some of you may be watching the video in the future. We have a website, taxpowerhour.com. We're working on it. It's under construction. We're going to add all sorts of resources on taxes all year long. Right now it's my tax season, so not until April 15th I will have a chance to add all that content. And we have a Facebook group, and we would like for you to continue the conversation, ask questions, share ideas, and just make the tax planning and tax preparation and even the non-tax accounting community to help small business owners out there and help each other deal with the ever-growing issues with tax. Anyway, this is a monthly webinar every first Wednesday of every month. Sometimes they will be 30 minutes long. Sometimes they'll be an hour long. I'm sort of committed to making it no more than an hour. Today's episode will definitely not be less than an hour. We have a lot of content today. We may have a special episode in the future that has sponsored content or collaborated content. That's kind of the purpose of building a community and doing the webinar, so we can monetize at some point with software companies that sell tax software or sell services or apps to the tax community. Will eventually have those as well, and those will all be value adding. We don't provide CPE or IRS CE for enrolled agents. This is not what we're doing yet, although if I get enough requests, we will consider doing so. And we'll have discussions on tax law, practical examples, maybe payroll issues, tax software, sales tax. Everything is open as long as it's got tax next to it. About myself, I am Hector Garcia. I am a CPA. I am the CEO of Garcia CPA, which is an accounting technology and tax planning firm. My email is hector@garciacpa.com if you need to reach me, and I'm also an advanced certified QuickBooks Pro advisor. My good friend Chris agreed to be today's guest. He's a CPA as well, and he's the founder and CEO of 3 entities. Chris, do you mind telling us a little bit about Halon Tax, Tax Planner Pro, and Ragain Financial?
Sure. So let me say thank you for having me on, Hector. We always have a good time, and I think whenever we get to chat about taxes and all the things going on, it's a lot of fun. Halon Tax is my newest software app, and it's kind of a joint collaboration between software and accountants. It does business tax returns, so it is a tax app that does business tax returns, 1120s, 1120Ss, partnerships, that kind of thing. Tax Planner Pro is a slightly older app that you can find on the QuickBooks App Store, and that helps both small business owners and accountants do tax planning for their businesses or for their clients. And then Ragain Financial is my accounting firm that I started some 15 years ago, and we do bookkeeping and taxes and payroll and the very traditional kind of accounting work that you would expect maybe from a CPA firm.
Awesome, Chris. Thanks for sharing. So definitely check out those resources. Halon Tax, which as I mentioned, is an outsourced tax preparation app and service for other accounting professionals that maybe don't want to get into tax, but they want to use Chris's expertise and knowledge together with his infrastructure to outsource tax preparation. There's also Tax Planner Pro, which is that website that can connect to QuickBooks Online and synchronize with the Tax Planner Pro website, which can create estimated tax payments depending on the corporate structure, and Ragain Financial, which is Chris's accounting firm. There's all the websites addresses on the screen. Please check out his resources. Okay, so let's go into our disclaimer before we get into the meat and potatoes here. A practitioner may not give written or electronic advice based on unreasonable legal or factual assumptions or representations. Basically, what that means is what we're talking about here, and maybe some of the questions that we may answer live, are based on strictly hypothetical circumstances. And this is not, and I repeat, this is not tax advice, okay? And also, we may never inadvertently or explicitly give advice having to do with something having a possibility of an audit reduce, or whether or not something will be audited or raised in an audit, or whether if it's raised in an audit, it would be guaranteed to be solved or not be able to be settled. So you never should ever hear any tax preparer ever talk about the possibility of an audit as a conduit to give tax advice. And practitioners cannot give legal advice. So if we inadvertently talk about the legal structure and legal responsibilities of corporations, we are not purposely giving legal advice. We're saying, hypothetically speaking, you should speak to your attorney for that. So again, none of this webinar, something that we're writing, answers that we're writing, things that we're saying verbally, or anything on the PowerPoint itself constitutes as tax advice. It absolutely does not constitute as tax advice. And also, this may not be used as a source for your own tax preparation and go to the IRS and say, well, I saw in the webinar you can do this, this, and that. That's not what this is meant to do. These are purely hypothetical circumstances. Consult your tax professional or advisor, including all your facts and circumstances for your case. And if you don't have a tax preparer, Google directory of federal tax preparers with credentials for the IRS official listing. If you want to hire one, you can call me. I'm a CPA. You can call Chris, the guest speaker. He's a CPA. And or you can email me and I can find you a local one or a specialized one. I have tons of friends and colleagues all over the world, so I can connect you with the right person if you have very specialized needs. Anyway, let's jump right into the topic here. And I'm going to spend about 25 minutes talking about business income, business deductions to set up context for the whole conversation. And then I'm going to explain each of the entities from sole proprietor to C corporation to S corporation to partnership, with a couple of really important bullet points, which I feel to be the most important things to discuss. And then when I'm done, we're going to bring in Chris to bring it all home for us and do the big conclusion and talk about the last observations, the most important observations that him as a tax preparer and a tax planning expert puts into practice when talking about multiple entity tax planning. So we're going to be speaking with the context of businesses or business activities. Now, income from businesses usually derives from the sale of services or the sale of goods. Now, one major issue that people have misunderstand quite often is if they get a payment from a customer, let's say, for example, the 25th of December, 26th of December, and it's a large one. And they say, you know what, I'm not going to deposit it in the bank until January because I don't want to pay taxes on that income in 2016 because the money got there in December, whatever. There's a concept of constructive receipt, which basically means that the tax law says if you receive a payment, and it could be a constructive receipt, quote unquote, so that could still be a check that you haven't deposited, that could still be deemed as cash basis income for that year. So I want to make sure we clarify that receiving a payment in December and depositing it in January doesn't mean that necessarily that the income can only be claimed in January. It could technically be claimed in December. because there's the concept of constructive receipt. Now let's talk about deductions or expenses. Now, as far as expenses, people always ask me, Hector, where's a list of expenses I can deduct from my taxes for my business? And there's no straight answer for that, because basically the IRS says anything that you spend that is necessary or ordinary, it can be deductible. Necessary and ordinary. Necessary means that there's a connection between the expenditure and your capacity to earn income. There's a connection between, or a requirement to make that expenditure in order to be able to generate the income. Now, ordinary means that it's normal, that is expected, that in the industry it's done often, or it's something that even the IRS has specific industry guidelines where certain type of expenditures are expected for that type of business or that type of structure or that type of industry. So that's what ordinary means, and these are all subjective terms. So if anyone ever thought that taxes were black and white, they're not. They're highly subjective. Also, they're very political. I don't want to get too deep into that, but taxes are highly politically charged. As a matter of fact, most tax law, it's passed with political motivations. And this may be true for 2017, 2018, the next 4 years, because of the administration change, new president, new Congress. And there may be a lot of bullet points or rhetoric that the politicians want to hit by passing some sort of tax law, which, in the long run, it has an economic impact. It could be an economic advantage or disadvantage, or a behavior impact as well. Because the government can manipulate how people spend their money and how they act and what they do and what they not do based on tax incentives. I mean, one of the interesting ones was, if anybody remembers, cash for clunkers. Back in 2008, I believe it was 2008, there was this program called Cash for Clunkers. And it was an IRS or a US government incentivized tax credit for people that have this high gas, high polluting vehicles, a clunker, and turn it in and get an IRS sponsored, a US government sponsored rebate on that payment. In other words, you went to the dealership and you turned in your clunker and you got a lot more than what it's worth because the government was subsidizing it. I mean, that is as politically charged as you can imagine. I mean, is there any real economic benefit for turning in your clunkers? I don't know. I guess the clunker looks better, it pollutes less, spends less gas. I'm sure there's some economic benefit, but it's as political as it gets. So it's very important to keep in mind anytime you look at tax law, tax incentives, they're very political. Anyway, that being said, expenses must also be reasonable. And reasonable is a very subjective term. So the example I make is, hey, if I'm an Uber driver, I do need my car to be able to make my deliveries. But do I need a Lamborghini? Well, I mean, I guess if I'm charging a lot more, and that's where reasonability happens. If I'm charging a lot more than the average Uber driver charges to drive people around in the Lamborghini, I guess I could deduct the Lamborghini to the extent that I have income. But if I'm a casual Uber driver charging regular Uber rates, I can't deduct the Lamborghini and go into a negative on my business because that would be unreasonable. So that's pretty much a good example for it. But this is very subjective. So it's up to the IRS auditor really to establish that. But of course, you look at averages, you look at reasonableness. It's also crowdsourcing some of this information, looking at statistics, that sort of thing. Now, in terms of deductions, there's the regular deductions which we discussed, and then we have some of the special ones like startup costs. The startup cost may be deducted in some cases a portion, and then the other portion has to be amortized over several years, kind of like depreciation. So it all depends on the amount, the size of the business, all that stuff. Capital expenses, these are investments into fixed assets. This is any purchases of value in which that purchase itself will not expire in value within the next tax cycle. In other words, if I buy something that is still going to be there next year, that's something, and it's still going to be worth a significant amount, it makes no sense to deduct it the first year. It makes more sense to depreciate it, which means I take away little by little the value over time. Because it wouldn't make any sense for you to buy a vehicle for $20,000 that will last you, 10 years and deduct the entire thing the first year you bought it. That's what depreciation means. It's we look at a table and we look at how much do we take the first year, second year, et cetera, et cetera. So it's cost over time. And there's also personal expenses or allocation, proration of mixed personal business. So one of the most classic examples is, home use of your home for your office, or for a home office. So can you deduct your entire house expenses? No, there will be a portion, right? What about your personal vehicle that you're casually using for business? Can you deduct the entire business? No, a portion of it. So personal expenses or expenses that have lifestyle type of or personal type of value, we have to allocate or prorate. So that's in a nutshell one really quick thing I wanted to talk about business income and deductions. Now let's talk about comparing the two extremes here, which is a sole proprietorship versus a corporation or a C corporation. We can call it C corporation, but at any point in time you hear the word corporation, we're talking about C corporation, right? Or a regular corporation. Now, both the sole proprietorship, which basically means I'm running the business under my own personal name, or a corporation, these are tax-paying entities, right? Individuals and corporations are both tax-paying entities. Starting calendar year 2017 for tax year 2016, the deadline for corporations moved to April 15th. It used to be March 15 for the longest time. This year it moved to April 15th. So both individuals or a sole proprietor filing a tax return under an individual and a corporation have a tax deadline of 4/15, April 15th. Really, really important to keep in mind. Now, also it's important to keep in mind that individuals have tax brackets and corporations have tax brackets, and they're different. Basically, a person gets taxed $100,000 at one rate, and a corporation gets taxed the same $100,000 in a completely different rate. Let's take a look at those tax brackets to see what I mean. Okay, so let's compare a couple of these tax brackets and tax rates. So for example, if we're talking about an individual tax filer, and that individual tax filer makes $100,000, okay, they're going to be in this 28% tax bracket, which basically means that they're going to be paying for the amount above $91,150, they'll be paying 28%. And then from 0 to 9,200, they'll be paying 10%. So if you actually start adding up what all these percentages mean, this is going to be somewhere in the $25,000 to $28,000 range for someone that it's making $100,000. Now, more at the 25 range. Now let's compare that with our corporate tax brackets. So for example, if you're making $100,000, you're going to be paying $7,500 in tax plus 25% of the amount over $50,000, and then plus 34% on the amounts over $75,000. So you're going to pay more or less $22,000 in tax. So there's situations in which individuals and corporate tax are at the same level, or in some cases, corporate tax could even be less expensive than individual, but then it does flip at some point where corporate taxes are a lot more expensive. Take a look at this. The top rate here between 100 and 330,000 is 39%. We're going to discuss why the buck doesn't really stop at that 39%. If you look at individual tax filers, they're also at that 39% range. However, to get there, you have to be already over $400,000 in income, whereas for the corporation, you can be between 100,000 and 335, and you're already at that 39% tax bracket. So it's really important to just keep in mind that a corporation and individuals have different tax rates, and there isn't a straight answer. Is it more tax to the corporation or to the person? Everything varies. Other sources of income, the tax bracket of the individual, all that stuff really matters. But the other really important thing to just kind of keep in mind here is that the US is actually known to be one of the highest corporate tax rates in the world. Like it's number 3, and according to taxfoundation.org, at that 38-39% area. So the US is known for having expensive, high corporate tax rates. On top of that, you will pay taxes in the state that the corporation is in. So for example, Florida pays 5.5% corporate income tax in Florida. Pennsylvania, it's almost 10%. Iowa is 12%. So you'll see that corporations, on top of that high tax bracket they can have, you have to add onto that state tax. I mean, there's tons of mechanics in which, that becomes effectively a lower number because state taxes are deductible from the corporate return and that sort of thing. However, the point is that it's not just the IRS corporate tax, it's also potentially the state corporate tax as well. So it's really extremely important to keep that in mind. You individuals and corporations have different tax rates, tax brackets, and this is why we compare sole prop with C corporation, because these are the two tax-paying entities. Now, on top of all that, a C corporation pays a corporate tax on the profits, and the individual pays a dividend tax or dividend income on the dividends received from that corporation. Now, in some cases, you may have the qualified dividend rate, where if you make under a certain dollar amount, this is normally for when you're in the first 2 tax brackets, the qualified dividend rate on your dividends are actually 0. But for most folks, they're going to be in that 15 or 20% bracket on that dividend. So think about this. You're going to pay corporate tax, let's say close to $100,000 in your profits on that 35-39% rate, plus pay an additional 3 to 12% in the state, plus pay a dividend tax individual. So this is what they call double taxation, and some people call it even triple taxation because of the state tax. So this is why a C corporation it's very it's actually highly undesirable because of this. Now, there are other advantages to having a C corporation, but typically taxation is not one. Now, again, I mentioned earlier, I have some clients that have C corporations and they pay less taxes than they would if they had a sole prop or any other entity, but it had to do with their particular set of circumstances. They happen to be very high income earning on the personal side with tons of personal income and being at the top tax bracket of the personal side, and their corporation makes very, very little, under $10,000 a year net profit, so they're going to pay a lot less tax by doing that. So that's a really important point to make. Now, it's also important to make, and it's one of those common misunderstandings, if a shareholder lends the corporation money, or the other way, the corporation lends a shareholder money, because a corporation is supposed to be completely isolated and separate from the person. They can't have any relationship. They have to be completely separate third parties. There has to be a note recorded, so there has to be documentation about the loan in order for that loan to be a loan and not to be a dividend, of course. And you have to pay interest. So if the corporation, quote unquote, lends the one of the owners money, and you want to call it a shareholder loan and not call it a dividend because you're trying to avoid that dividend tax, you better be charging interest on that loan, and you better have documentation, because otherwise it will be deemed as a dividend. Now, the other important point to make is health insurance on a C corporation. It's a benefit to their employees, even if the employees are owners, and none of the effects of health insurance premiums pass through the personal return, which is different for partnerships and S corporations. So we'll discuss that. Now let's take a look at comparing partnerships versus S corporations. Now, so we're done with the topic of sole proprietorships, individuals, and C corporations, which were the tax-paying entities. Now let's talk about partnerships and S corporations, which are the non-tax-paying entities. This is what they call pass-through. That means the profits from these entities, a partnership or an S corp, pass through the owner's tax return or several owners' partners' tax returns, and the taxes are paid at the owner's partner's tax bracket. That's why it's so important to know corporate tax rates and personal tax rates are different, right? Now, partnerships must have at least 2 partners. You can't have a partnership with only one partner. That's just a person. So it has to have at least 2 partners or members for it to be a partnership. Now, generally with partnerships, you could have a general partner that's active, that works the business, and you can have passive limited partners that are not actively working in the business. Maybe they don't have liability. It's been structured that way. They're just passive investors. They don't have a say on how the money gets distributed, all that stuff. And in certain cases, passive limited partners do not pay self-employment tax on the profits, whereas always active general partners are going to pay self-employment tax on the pass-through income. Now, what's self-employment tax? That's Social Security and Medicare. It adds up to 15.3%. When you're employed, usually that expense, that 15.3%, is split. Your employer pays half and you as the individual pay the other half. So you don't feel that big of an impact on it. But when you're self-employed, you pay both what the employer would pay and what you individually pay, obviously, right? Because you're self-employed. So all incomes from partnerships that pass through general partners are taxed with self-employment tax, which means that you're going to pay the self-employment tax and you're also going to pay your income tax. So there's 2 taxes basically that you're paying with a partnership. Now, one of the good advantages, talk about the good stuff, the good advantages of a partnership, it's flexibility. With a partnership, you can choose which partner gets the taxable profits, which partner gets the tax benefits of a loss, which partner gets a capital allocation for when it comes to time to selling the business. And that's regardless of whatever the quote-unquote ownership structure is. Now, in partnerships, there's a concept called guaranteed payments. Guaranteed payments, basically, it's when partners pay themselves a distribution payment before profits are calculated. Basically, it's guaranteed. That partner is guaranteed to get that. And typically, guaranteed payments are for compensation. It's when 2 partners say, you know what, for showing up every day, you're going to get $2,000 a month. Because I only come on the weekends, I'm going to get $1,000 a month. Those are both guaranteed payments. They're calculated before profits. And then the profits are distributed across partners. Now, when you're employed in a corporation, you get W-2. You don't get a guaranteed payment. You get a W-2. And owners of a partnership should not be in payroll or cannot be in payroll. So an owner of a partnership should never have a W-2. They should have guaranteed payments, and which are reported in a form called the K-1, which I'll talk about briefly. Now, in comparison, a partnership could have anyone as an owner. It could be another partnership. It could be a corporation. It could be a foreign entity. It could be a foreign individual. So partnerships can have anyone, anything as the ownership. In an S corporation or a subchapter S corporation, which is basically legally a corporation, but for tax purposes is a special election, that's only for a maximum of 100 shareholders. And you must be a resident or a U.S. citizen. So someone with a Social Security number, someone residing in the United States. That that owner can be an owner of an S corp, and it doesn't have to have two minimum. It could only have one owner, and that will be fine. Now, so basically those are the restrictions of the S corp. Now, there's also another restriction, which is profit and loss are allocated according to ownership structure. It's not flexible. You can't choose it. You can't by partnership agreement say, well, this year we're going to take, Jimmy's going to take the losses and I'll take the gains if there's such a result. No, for an S corp, you get what the ownership structure is. You get that allocation. Now, the nice thing about S corps, this is the big, huge, humongous, great thing about S corps, and the reason why they're so popular, it's because the pass-through income or the profits are not subject to self-employment tax. So a partnership passing through $100,000 in income versus an S corp passing through $100,000 in income have exactly a $15,000 difference in tax. Partnerships are more expensive. Why? Because you have to pay $15,000 or 15.3% of that pass-through income as self-employment tax. So there's a huge benefit to having an S corporation instead of a partnership, because you will save yourself self-employment tax. Now, what's self-employment tax? That's Social Security and Medicare. Okay. Now, what are the important caveats behind this? Is that although you can avoid paying self-employment tax using an S corp, you cannot evade it, right? You cannot create an S corp as a conduit to evade self-employment tax. Remember the political statement I was making? No Congress member will go back and tell the American people it's okay not to pay self-employment tax because our Social Security is overfunded and our Medicare is overfunded, which is not our reality. Both our Medicare and Social Security are, I don't want to say broke because I don't know those numbers, but they're underfunded. So, why does the IRS even create a conduit for not paying your taxes into your self-employment fund? Now, I don't know the reasons why they did it, but they did it. And the caveat is that if you have an S corporation, the owners must pay themselves through payroll with a W-2, with tax withholding, through payroll, reasonable compensation. And they threw that out there with an extremely subjective term. You can actually search reasonable compensation IRS, and that's actually in the code, in the tax law. Now, reasonableness has all sorts of dimensions. That has to do with, how much profits did the company have? Did it make sense that X, Y, and Z amount went to the owner as compensation? Does the owner's role in that S corp, what is it worth in the marketplace? What would it cost to replace that person with an actual employee, and what would you have to pay the role of that business owner in it? So there's different techniques to figure out, quote unquote, reasonable compensation, but the point is that the amount put through payroll, that is going to be subject to paying Social Security and Medicare. So technically with an S corp, you don't avoid paying self-employment tax on the whole thing, but you can do it on a portion of it, and sometimes a sizable portion, as long as you can make the case for a low enough reasonable compensation to the partners, to the owners, I mean. Now let's talk about what partnerships and S corporations have in common. Well, number one, both are separate entities that don't pay taxes, but report the results to the owners or partners through a form called the K-1. Both partnerships and S corporations have what they call separately stated income items, which separates ordinary income from passive income from portfolio income. In other words, ordinary income, regular sale of goods and services, that passes through. If I have any real estate or royalties, that's going to pass through as passive, and that may or may not have a beneficial tax treatment. And then you have portfolio income, which is basically a buy and sell of capital assets. So if the S corp owns stock and they're selling stock and there's some capital losses, those losses don't 100% reduce your ordinary income, because in the individual tax return, portfolio income has its own calculation. So that's really, really important, that a partnership and an S corp is basically there to report the numbers separately, but then at the end pay it as if it was a sole proprietorship anyway, with the exception of the S Corp and not having to pay self-employment tax. Now, both of these entities can also pass through losses. And when you think about tax planning, you want to know if the entities are going to have losses, and it is possible to reduce the taxability of ordinary income from other sources. And if that's the case, then those pass-through losses are beneficial. Now, pass-through losses have limitations in some cases, and also you have to have your investment at risk, and you have to have basis. Basically, that means you have to have skin in the game. So if you own enough of the corporation and have enough money invested, or you have personally guaranteeing some of the liabilities from the corporation, that's all called basis. And as long as it's at risk, that means you could lose it, then those pass-through losses could be passed through and they could be beneficial to the individual. Now, health insurance, I don't want to get too much into the details of health insurance, but it's important to know health insurance is one of those separately stated items that I talked about through the K1. So health insurance is actually an expense, a potential expense on the personal tax return under a line called self-employment insurance premiums. However, the way they're reported is different. With a C Corp, it's just a corporation expense, and it doesn't have to be reported on the personal return. With a partnership or an S Corp, it may have to be reported in a very specific way. Especially with S Corps, you have to include that benefit in the W-2, and the mechanics become a little bit hairy, which is important to have a payroll service that would do those adjustments for you. Now, the last thing that both partnerships and S Corps have in common is they have the same deadline. So both partnerships and S corporations are due on March 15, not April 15, and you can extend them for 6 months. You can extend them all the way through September 15. Now, partnerships and S corporations, even if they have no profit, have substantial penalties for late filing. Very, very large. They're about $200 per owner per month, and there's normally a cap of 12 months. So a one-person S Corp that hasn't filed returns or is late a year could be paying close to $2,400 in just late filing fees. In a partnership with two partners that, again, hasn't filed the return and is late 12 months could be paying close to $4,000 or $5,000 in penalties just for filing late. So you got to file those on time, and you got to file those extensions if you can't get it done by March 15. Now let's move on to what's an LLC. And this is one of the big questions I have, because people tend to add LLC as one of the choices. We talked about sole proprietorship, we talked about partnership, we talked about S Corp and C Corp. But in reality, there's really one type of entity called the corporation, which you can choose to change to S Corp for tax purposes. And then I think all states have LLCs. But I know at some point in time, only some states had LLCs. But LLC is a state thing. It's a legal state thing. It has nothing to do with the IRS. And what the IRS basically said is, look, if you have an LLC, you get to choose how it's taxed. If it's only got one owner, by default, you doing nothing, it's basically as if it was no separate entity. It would be just like a sole proprietorship. This is what they call a single member LLC. If it's got more than one partner and you don't make any special elections, by default, it would be a partnership. Now, you can elect to convert an LLC for IRS purposes, convert it to a C corporation using a form number 8832. Therefore, you can legally have an LLC, but tax-wise, you can have a corporation. And you have to make sure that in your state, also you're registering that to be a corporation too, because some states or most states won't require you to file an LLC tax return because it's a pass-through entity. Again, some states, I don't want to say all states. And then you can double convert or dual convert to a C Corp and an S Corp using two forms, Form 8832 and 2553. So the LLC is basically the best of all worlds. It gives you the capacity to choose how you want to be taxed. So if you're not consulting a tax professional and you're not sure, just do an LLC, and hopefully by the end of the year, when you do consult a tax professional, you can make all these conversions. And most of these have late election provisions where even if you don't make this election proactively, you can make it reactively when you file a tax return. So I'm going to let Chris, I'm going to go to the next slide. I'm going to let Chris basically summarize everything for us with the next couple of slides. Chris, I'll move the slides for you. Go ahead and take over.
Sure. So the purpose of this little matrix here is to kind of talk about legal entity versus tax entity. And we get confused a lot of times between these two different things. So up at the top, you can see we've got sole proprietor, corporation, and limited liability company. These are the three types of structures from a legal perspective, meaning how we register ourselves at the state level, that you can set up. I mean, there's some other things that you can set up too, but these are the big three. Now, a tax status of each of these is disregarded entity, S corporation, and partnership. So it is bad form to say, well, I don't know whether I should set up a limited liability company or an S corporation. That technically isn't accurate, because S corporation is a tax structure versus limited liability company is a legal structure. A corporation or a limited liability company can both be S corporations. A limited liability company can be a disregarded entity or a partnership. All of this is important to kind of understand as we communicate to clients, or as you're thinking about this as a business owner, because the legal entity you set up in many ways is because of legal and liability issues. So the legal entity, like a sole proprietorship, I equate that to kind of walking around a mall naked, because you have zero protection in a sole proprietorship. Whereas in a corporation or a little limited liability company, they both come with limited liability protection. Once we've kind of decided on our legal structure, i.e. our liability protections, then we need to decide what our tax structure is going to be. And that can be a disregarded entity, an S corporation, or a partnership. So hopefully that sets the landscape up for how we're going to talk about these things. And go ahead and move that slide, maybe, Hector, and I'll get into that.
I'll do that. Let me just add something. There's a little bit of legal talk here, and of course, we made the disclaimer that we're not attorneys. We can't make legal advice and everything like that. I'm actually talking to a friend of mine, a lawyer, that may come in July or August on an episode to discuss legal aspects of corp compared to tax aspects. However, there's a reason why it matters, the legal entity status, is because in a state, you may have something called corporate law, and you may have something called partnership law, right? So depending on what state you're in, how people can sue you, how you do resolution for disputes of a commercial transaction, how partners that fought over misunderstanding of partnership agreements matters based on your legal structure and your rights, your liability, your capacity to sue, your capacity to collect on damages, the capacity for your spouse to take your shares, take control in a divorce case over your corporation or partnerships vary based on the legal entity, and this varies state by state. So that's why it's important to separate the two, because there's a lot of context on the legal world that has nothing to do with stuff that Chris and I know or can give advice on that affects it. So I just wanted to make sure I add that, Chris. I move the slide.
So sole proprietors, you'll almost never find me recommending a sole proprietorship. Some people may have a different opinion. I don't know why I would ever offer this to just about anybody, because and these four boxes are going to kind of be consistent across some of these slides, but the liability risk, as we can see in the top left, is extremely high. A sole proprietorship provides no protection to you from legal suits that your business may become involved in. Once you lose that suit, not only can they go take my business assets, but they can also take my personal stuff. Obviously, the reason people like them is because the setup costs are low. I can walk out my door and I can be a sole proprietorship. The operational tasks are very low. But I would also say that scalability is the structure's helpfulness in becoming larger and larger as your business grows. If you're a sole proprietor, you essentially have a lot of trouble assigning tasks and duties and liability for jobs to other employees or other owners or other people because you have no ability to do that. So I can't really even put someone else on the bank account for a sole proprietorship unless they are willing to take on the risks that come with that. And if you are a sole proprietorship and you take on another owner, what are you now? You're a partnership. So sole proprietorship is not really very scalable at all, but super easy to set up. Now, I'll tell you, if somebody's going to make less, and this is just my opinion, if somebody's going to make less than, let's say, $10,000, I have a lot of problems in recommending a normal corporation because they may not even have the ability to pay the fees that are associated with that. However, and this is especially important for the accountants that are watching, there is no reason to recommend a sole proprietorship. I understand that you might be trying to save your clients some money and that kind of thing, but eventually we are then taking on the responsibility of also saying, if we recommend that, oh, hey, by the way, you now need to be something else. You've grown enough to where you now need to be an LLC. You need to now be a corporation. You need to do all these other things. So I typically, if new businesses are walking in my door and they say, well, we just don't know how big we're going to be, I almost always say you still need a legal structure, whether that be an LLC or corporation or not. Doesn't mean they can't be a disregarded entity and file on the Schedule C still, but I'm going to try and have them be some kind of either LLC or corporation so that they have some kind of limited liability. There's just no reason why I would ever recommend something other than that.
Right. And then I just add something real quick, which we can't put in writing, but statistically speaking, sole proprietors get audited more often than corporations. Now, there could be multiple reasons for this. It could be also because they're prepared wrong so many times because a lot of sole proprietors don't use professional tax preparers, where most people get scared about preparing a corporate return and they end up using an accountant, and maybe that has something to do with it. But a sole proprietor, basically an individual filing an Schedule C with business income, it's audited 3 or 4 more times, more often than a corporation does. So that's something I wanted to throw in there. That could be another added benefit for not using a proprietor. Go ahead, Chris.
Sure. And so the corporation, the liability risk here goes down, so it gets a green box. The setup cost is moderate. I tend to lean towards a corporation over an LLC sometimes, and I'll explain why that is, although both are very, very good. Operational tasks for a corporation are high. You have to have shareholders meetings. You have to keep much more documentation when you set up a corporation. You have to have minutes, and you have to run the corporation like a corporation. So the problem with small businesses doing corporations tends to be that they want to run it like a sole proprietorship. And that is, to me, a very high danger zone, because I think the IRS likes to look at something like that and say, we're going to disallow maybe even an S election because you're not really running this like a separate entity. You're running it like a sole proprietorship and mixing all your business and personal expenses in there. So the operational side of this needs to be done correctly, and it should get a high rate, a red box for that. But again, the scalability of a corporation is great. I tend to recommend a corporation most of the time.
And the best way to just corroborate with high scalability is that 95% of companies in the stock market, public companies, are corporations. So if you ever aspire to be in the stock market, you're probably going to want to be a corporation. Not that you have to be now, and you can also obviously convert and that sort of thing. But that just basically resonates with the whole scalability concept.
And there was a question just now that was asked that said, is that C or S or just C? Remember, Corporation, when I say corporation, I mean the legal structure. C and S corporation are tax elections in the way that the company is going to be taxed. And that is a different kind of question than what you should initially be asking yourself from a legal perspective. Why am I setting up a corporation? So don't get those two things mixed up too much. A corporation or a limited liability company, they have different reasons why they exist. Like we've moved on to the LLC here. Now LLCs have only been around for about 40 years. And the reason they were created way back in the day was that entities needed more flexibility with the way that professional services were provided. And I don't have any stats on this, but I will say that most people tell me they want an LLC not because they know the difference between an LLC or corporation, but because LLC sounds cooler, doesn't it? I mean, LLC sounds progressive. And in many cases, I would actually say that an LLC, especially if you're a single member LLC, it has less case law that defends you than a corporation does. The corporation goes all the way back to the East India Trading Company, right? And has lots and lots of case law showing that it is a protection that is afforded through many different scenarios, whereas an LLC is not. However, I would also say that an LLC, if you're a professional organization, comes with some law and some case law that applies specifically to your profession and can sometimes be extremely helpful, especially if you are being sued and they are able to prove that you didn't have, you maybe heard of this term scienter, which is an intent to harm, but that you won't find many protections for anywhere. But if you are just negligent, meaning you did not know you were harming someone when you did something, an LLC has lots of case law that shows that in most cases it should protect you in that situation. Again, I find also that LLCs tend to be more expensive than corporations, so that's why they get the setup cost high, the red box there. Scalability is moderate, maybe not fair. Sometimes I think LLCs are a little bit harder to scale from the perspective of they are an entity that has less case law, and thus you're not quite sure of all the protections that it offers. Operational tasks are high like a corporation would be because it still needs meetings, that kind of thing, and the liability risk is low. But if you're curious which you should be, liability versus corporation, that is really where you need to engage that attorney, because it would be impossible for the accountants of the world to try and really say why, because it is a legal question. It is not a tax question. All of these entities can be taxed as an S corporation or a C corporation, or the ways that you want to be taxed in them. So I would go to attorneys if you're really trying to figure out the difference between them in a specific way for a client or for your business.
Right. And just to add a comment there, when you're talking about case law, you're not talking about tax cases. You're talking about legal cases.
I'm talking about actual doctor got sued by patient kind of law.
Exactly. Perfect. Okay. So there's the next slide.
So in each of these, what these slides are meant to do is kind of talk about what you can expect from a tax perspective, because now we've gone from the legal side into the tax side. So the disregarded entity, sole proprietors and LLCs can be disregarded entities. And what it means is that entity does not file a separate tax return and will file as part of the individual's tax return. In most cases, a Schedule C, but not always. These entities can also file on a Schedule E if they're a rental operation. It can be a Schedule F if it's a farm operation. It can even if you're operating rental activities, you could file on a Schedule C if you want that to be an active business in that same way. So from the perspective of how you're being taxed, LLC, sole proprietorship can both be disregarded entities. Most of the time, this is not something that I'm much of an advocate for, because I think being taxed separately has tax advantages. Being an S corp or a C corp or a partnership has more tax advantages, and they also have other advantages. Meaning, Sometimes it's better just to have your business income and expense reported as part of a separate tax return. It makes selling your business much easier, I find, and it makes getting mortgages much easier, I find. So there are reasons outside of the tax world that I like not using disregarded entities, but they're needed if you don't make enough money to justify the cost of such things.
Sure. And if you're going to sell your business, you're probably not going to sell it to the first person that comes in to look at it, especially if you're selling it in a public venue. So how many people do you want to go out there and give them your personal tax return for them to investigate the numbers of your business before they buy it? So yeah, big no-no from my perspective of having one tax return that contains business and personal. So I agree with Chris 100% on that being a huge functional reason to have a separate tax return.
The S corporation is definitely my entity of choice. I like them both for their simplicity when it comes to filing a return versus the 1065. Not that the 1065 is that much different, but I think an 1120S is slightly simpler. I also have many clients that are trying to take advantage of a reduction in what is required to be paid for FICA and self-employment tax. The drawback to the S corporation should be noted in that it is completely inflexible. So if you're trying to hand kids off shares of your company and you don't want them voting, S corporation's bad. If you're trying to bring on new partners and you do not know how much they should be earning from the business before they really get underway and going in it, a bad structure for this. So this is a much better option for companies that are a single owner, or companies, if they're multi-owner, they know exactly how they're going to run it and that they're going to make sure that it's fair. And at some point here, I want to talk about my superstructure, which involves a partnership and a series of of 1120S's, S corporations, but we won't do it yet because we've got some more slides to get through. But the S corporation's definitely kind of my go-to entity. The partnership is, the reason I don't love the partnership, again, is I think it's more work. So the cost of the tax return, I believe, tends to be higher. I believe there's more basis work that has to be done in a more manual way than in an S corporation, although I could say that both have basis issues and have work that has to be done there. The tax efficiency of the partnership is very low. Everything gets taxed on the self-employment side of things, and there is all these different partnership basis concerns when you go to sell the company that you don't necessarily always have when you have an S corporation, and that's getting in the woods a little bit when you're trying to sell partnerships versus S corporations. But at the same time, LLCs can be partnerships. LLCs can be S corps too. Even if you don't set up a structure at all, and it's just two people working together, which you could call a joint venture, you could call it just a de facto partnership, you still have to file it on a 1065. So a lot of times you'll have two people come together because they were selling stuff on eBay, let's say. It's a really small business, and they go, oh, we just do that both on our individual Schedule Cs. We just split it ourselves of what we earned. No. The IRS would look at it differently. They would say, you guys need to do a 1065 and then split it via the K1.
Right, exactly.
So comparisons-wise here, this is a pretty good slide, I think, and if you've got the ability to take a screenshot while you're in the video here, I would do so, because it just kind of goes through as a reminder of what the differences are. I won't go through all of them. I think I'll take this time to kind of mention what I normally do in a multi-member situation. In a multi-member situation, which means I've got 2, 3, 5 different people setting up a business together, I will normally create an LLC that is a partnership at the top. So that is the operating entity. That is the parent entity. That entity will then be owned by several S corporations, and those S corporations are owned by each owner. So instead of setting up, if I've got 2 or 3 people that come in my office and they say, we need to set up a business, and I say, well, let's just make you all 33% owners, 33.3% owners of this business all say, okay, let's set up the top level entity, then your S corp, you'll each have an S corporation, and that S corporation will own 33.3% of the parent company. And the reason I do that is because I find, and this isn't so much a tax thing, although it does help somewhat on the taxes. The reason I do it is because I have found over, 15, 17 years of doing this, these businesses eventually start to have fights over what the business is going to reimburse and pay for. And I'll give you an easy example. One owner drives a Cadillac, and one owner drives a BMW. And the Cadillac costs $700 a month, and the BMW costs $1,500 a month. Well, if they were all in one entity, reimbursing for their use of that car and being able for them to write off the cost of their car becomes very difficult because the amounts are so different. Now, some would say, well, why not just give them some kind of mileage allowance? Well, the guy who drives or the gal who drives the BMW isn't going to be very satisfied with that, especially if they lease it, because they'd like to write off a much larger portion of that lease than the mileage allowance would allow. So by putting them each in these S corporations, much of the expenses that they all want to share, like the rent of the building, the staff that they pay, the expenses that they all agree are each of their responsibilities in the right percentage, that should be expensed at the parent level. But anything like telephone, paying kids, cars, shareholders meetings, all kinds of these things that can be very different for each owner, we do all of that work at the S corp level. That way they can all take as aggressive or as meek a deduction as they want, and nobody gets into some kind of argument. The parent company distributes the income to each of these S corporations in the exact same amount usually, and then a lot more tax planning happens at the S corp level.
Now, I want to make a quick comment to that. It is obvious that with a structure like this, there's a whole bunch of complexity because now we're talking about filing. Let's say, for example, you have two partners. Let's simplify it like that. We're talking about filing 3 tax returns instead of 1 tax return, having 3 sets of bookkeeping, and potentially 2 of them having payroll as well. So what you call a superstructure, it's also going to be a much costly thing for the taxpayer. However, taxpayers usually don't complain if the tax benefit is above and beyond the professional fees being charged. So that's when we have to, deliver a lot of value and make sure that it's communicated. But I completely agree with you. That's how our partnership is set up like that. For my accounting practice, we have one LLC, which is the one that serves the clients, and then each of us have our own S corporation. And then the clients that we decide to take out to eat, that would be each of the partners' business, and allow the partners to have flexibility on what cars they want to drive and maybe potentially what they're being too aggressive on, and not hurt the overall corporation or the customer-facing corporation. I love that, Chris. Thank you very much. Let me do, and if you have to go, you can leave. If you want to stay, you can stay and answer questions at the back end. Let me wrap this up by adding what I call the non-tax consequences of operating a business. So Chris talked about negligence and some other situations, or maybe something. What was the term that you used? To use that legal term for when you want to do harm.
Oh, scienter.
Yeah. So if there's scienter, or if there's gross negligence or fraud, you're not gonna have protection, right? However, even the limited liability can be pierced if any lawyer can make the case that your entity is not run like a business, doesn't have a separate set of books, doesn't have separate branding. The owner conducts himself as a sole proprietorship, even though it's hiding themselves behind the business. So it's important to know that a corporation by itself it's not automatic liability limiting. You have to do all, especially on the financial side, keep those finances completely separate to avoid somebody being able to pierce that corporate veil and not have that liability protection, which is the number one reason why anyone incorporates in the first place. Obviously, tax is definitely important, but for a lot of reasons, for liability protections, is probably one of the most common reasons why people incorporate. The other thing is the annual state fees or annual reports. So if you have a legal entity registered in a state, the state may ask you to file fees every year. Like in Florida, for example, you have to pay $150 every year to maintain your corporation open. In Delaware, God knows how much it costs over there. Delaware knows that it's a popular place to incorporate. And maybe we'll have another episode just for Delaware, Chris. I'll invite you to that one if you can provide some value there, because
Oh
Delaware.
man, I'm here to tell you. I hope I if you ever do a Delaware filing or a consulting on it, make sure whoever's doing it realizes what the franchise taxes are in Delaware and organizes the shares correctly.
Right.
Um,
I find that 9 out of 10 people that incorporate in Delaware, they do it for the wrong reasons. Some people say,
yes.
"Oh, I heard it's less taxing. I heard it's more anonymous. I heard blah blah blah." Whatever. They always know. They never know why they do it, but somehow Delaware did awesome marketing on convincing people to incorporate over there. And honestly, I don't know enough about it, but if you're not a credit card company, which there's a whole other conversation on the liability for
Yeah.
credit card companies. I don't understand why you are incorporated in Delaware. Anyway, we'll
Absolutely.
pocket that conversation. You also may have filing requirements, like you may have to file a tax return in the state, right, with a corporation. So you not only have the IRS, you also have the state, and you have to make sure that you file that final return. I'm telling you, whoops, I want to change the spelling there because I put filling instead of filing. Happens very often. So a lot of people forget to file the last tax return after they close the company with the IRS, and they get hit with penalties, especially in Florida. Florida doesn't mess around with fees. It is almost impossible to get a Florida late filing or non-corporate filing fee abated. Anyway, you also may have not just corporate state taxes, you may have sales tax and payroll tax that you may have to register in the state to be able to function. That's another important implication of having an entity. You also may have state and municipal compliance. So, for example, if I'm a sole prop working from my house, the city you live in may not require you to register with the state, with the city or with the county. Of course, they're going to want you to pay, but generally you don't. But if you have a corporation that's a legal entity and it has a registered business address, you bet your butt that the state, the county, and the city is going to be searching to see where you're doing business and try to slap you with occupational license requirements, business tax receipts. Make sure you have the fire department out there to make sure that you can see customers in public. In some cases, require you to have general liability insurance if you have customer facing. So by creating entities, you may have all these non-tax consequences or beyond income tax consequences. There's also, as Chris mentioned, corporate formalities. I got to have my annual minutes. I to have a stock registry. They have this thing called the black book, which is black book is kind of like a colloquial term, but you can Google corporate black book and you're going to see a bunch of companies that give you a blank black book. And so many of my clients go online and they buy the black book but never fill it out with anything. So it's basically just a big paperweight. But you got to have a black book, which is, you have all your minutes, you have all your stock information, your bookkeeping, all that stuff. And also, of course, bookkeeping. If you have a corporation and you want it to have its liability, you got to have its own bookkeeping. You also have to maintain a balance sheet, which is the hardest part of non-accountants to do if your company has more than $250,000 in sales. And you may have to have accrual basis accounting if you're a larger entity. So there's all sorts of implications of having an entity versus being a sole prop. And of course, one of the single most important things, and I can't stress this enough, if you got more than two people in a business, do you have your partner buyout plan? Like, you should never set up a corporation with more than two owners if you don't already have the buyout pre-written down. In other words, you think of the divorce before you get married. And the problem with that is because if a partner dies, it's really complicated to have all of a sudden my partner's let's call it wife, be now the co-owner of my business and have the same rights that my partner had, maybe not knowing anything about it, or vice versa, right? So whatever the spouse may be. Also, our partnership maybe doesn't work out really well if one of you decides to just leave and leave everything behind, or maybe even leave liability behind. So the partner buyout planning, it's not the tax planning, but it's a really, really important part of having an entity with more than one owner. Chris, if you're still there, if you want to add anything to that particular line at the bottom.
Well, it's something that people don't think about nearly as much as they should, and especially if you have owners that are planning on doing something with their children. Not only do you need to be thinking through the valuation of things, because you can't just gift it to them, but you've also got to be thinking through what happens if this plan needs to be pushed forward faster in the event of a death. So as accountants, sometimes we think to ourselves, well, and I think this in my own practice, I'm like, well, I don't really get paid, to do a lot of buyout planning here. That's not what they engage me to do. But something that I do quite a bit is I'll say something to the effect of, almost in a cynical way, I'll say, I hope Aaron is ready to, pay $1 million at a moment's notice for this farm, because as far as I know, I don't think any planning for him to inherit this has really taken place. And the idea of that is to kind of jolt him into, oh gosh, I need to do something here. And it probably goes more to my thesis of managing clients in general, which is you have to do, sometimes the niceties are not nearly as effective as the scary story. And they will thank you later for mentioning things like this, and it can be an extremely scary thing if they're not planning for how this would work.
Yeah, every single new client that I start the conversation talking about, hey, what's going to happen when you die, doesn't like the way the conversation is going. But
Yeah.
but I tell you, I have not had one client that hasn't thanked me for having them think about that, because they seeked an attorney, and the attorney talked about trust and all these things, and who would have the rights to operate their business. In a lot of ways, a business, it's somebody's most important legacy. Now, that being said, the most important legacy should be your children, they're good to do to the world, whatever. But from an achievements perspective, like if you think of Bill Gates' achievements, nobody thinks about the Gates Foundation. They think about Microsoft. Does that make sense? Although technically speaking, philanthropically speaking, Bill Gates' achievement, in what he will bestow upon the world when he dies 150 years from now, because he's connected to a computer, right? Or he is a computer. But his achievements will be Microsoft. It won't be his foundation. So in a lot of ways, people's legacy is their business, and not thinking about what will happen post mortem, or maybe when you retire. It's a really important thing. So if you want to be a trusted advisor, if you're a tax preparer, these conversations are a great way to at least get in to start thinking about it. Now, Chris, thank you very much. I appreciate you being on. We went over time at least 40 minutes. We thought it was going to be an hour.
Oh, it's my pleasure. My pleasure.
So I really appreciate it. I'm going to put Chris's slide back up, because, again, Chris is an incredible, resourceful person, not just as a professional tax preparer. I'm not sure if he's taking new clients from now until April 15th, but as a professional tax preparer, he's great. His information is RagainFinancial.com, and he's got a software company called Tax Planner Pro, which is basically a software that connects to QuickBooks Online and does tax planning, proactive tax planning, to calculate estimated taxes or the tax impact of a business. And Halon Tax, which is gethalon.com. It's basically a tax outsourcing service that allows accounting professionals that maybe don't get too much into tax and want someone that's really, really extremely good and can deliver, high value tax services in a very sort of retail price, you can use Halon. So look into what Chris is doing. Get Halon.com, Tax Planner Pro, and Ragain Financial. And Chris, we appreciate very much coming onto the webinar.
Well,
Um,
thank you, Hector, and I appreciate it very much as well.
Awesome. Let me just go through the last couple of slides here because we still have a couple of folks on. And by the way, thank you for staying way past the time. We have the next webinar. It's exactly in a month, first Wednesday of April. We're going to have my friend Mariette Martinez. She's an enrolled agent, and she is kind of an expert on working with self-employed individuals. So we're going to talk about independent contractors, self-employed individuals, employees, and how all tax planning changes across for those individual folks. Then on May, we're going to have my friend Heather Satterley, which is also an enrolled agent. We're going to talk about depreciation, expenses versus fixed assets, and something called cost segregation for real estate and stuff like that. And then on June 7th, we're going to have my attorney friend, who's a CPA and attorney, do a presentation on international taxation. So all these topics should be awesome, and stay tuned for those. Now, there's another webinar in exactly 20 minutes called Excel Power Hour. It's a monthly webinar series about Excel or for Excel power users. And we're going to talk about VLOOKUPs and pivot tables. So you go to excelpowerhour.com to register for that. And you can basically stay on and hear me talk for another hour, this time about Excel. QB Power Hour is another webinar that I'm involved with. Tomorrow, there's an episode. I didn't put it there, but tomorrow there's an episode. 316, there's an episode. That's every other week. To register for that, go to qbpowerhour.com. This is all about QuickBooks. And I have another webinar called Enterprise Expert, which is a monthly webinar. Next episode is April 19th, and that will be on QuickBooks Enterprise, less known tips and tricks. Anyway, visit our website. Right now, there's not much information there, but keep it in mind we're going to add some stuff later on. Join the Facebook group. Just basically search in Facebook, Tax Power Hour. Join the group, join the conversations, ask questions. Let's build a community about small business tax. And my email is hector@taxpowerhour.com. Again, thank you very much for attending. And I will email every single person the recording. And also, I will email the slides. Thank you very much, and have a wonderful day.